Index option trading. There are many types of trading in the stock market. One of the advanced category is options trading. Futures and options, in short called F&O, are called derivative instruments. They are called derivative because they derive their value based on an underlying instrument. For example, a stock option gets its value based on that particular stock price. The options are financial contracts, which give the trader the right, not obligation, to buy, sell the underlying. They are dealt in lots, which represent a specific quantity. Since it's a contract, naturally it has an expiry date. From trader's perspective, it's simply bought or sold like any stock. But the buy-sell happens on the premium, which is the price of option contract, and not on the price of underlying. The points which differentiate the options from that of stock trade. Lot size. Options can only be traded in terms of lot, predefined number of units. Expiry. Options have a specific expiry date. There are weekly and monthly expiry in case of index. Type. There are call options and put options strike price. The option contracts exist for different prices, in steps of underlying. Option Greeks. Option Greeks are the parameters, which characterize mathematically the price behavior of them. While understanding each of the point can become a specific video by themselves, here we can see how options can be traded. We can understand the concepts using index options. They are explanation about the concept, and it is advised to make the trade after understanding the implications and behavior of options to a good level. When we talk about index options, the underlying is an index, which actually cannot be bought, sold. It's only the F&O contracts, through which the index can be traded. Imagine the Bank Nifty is at 40,000 level. You have a bullish view on the market and you expect that the Bank Nifty will go to 41,000 in a week's time. In such case, you can buy call option of it in current weekly expiry. Remember, when you buy an option, you pay the premium price X lot size. Technically, this is your complete risk. It can become zero, but you can exit your position at a particular price if it goes against you. Now, in between 40,000 and 41,000, there are many strike, each 100 point. So, you will have to decide which strike to choose. Another possibility, when you have a bullish view, you can sell put options. Buying a call or selling a put will give you profit if the market moves up. In contrary, if you are bearish and if you expect market to go to 39,000 in 1 week, you can do the reverse. Either you can sell call option or buy put option. They both tend to give you profit if market goes down. Again, which expiry to select and which strike, this can only be decided if you are aware of the current market scenario. Volatility, option Greeks, such as delta, theta, etc. Depending on the current market price of underlying, the strikes are categorized mainly in 3 parts. At the money, ATM, in the money, ITM, and out of the money, OTM. Since options contracts exist at different strike and expiry, instead of buying or selling on strike at one expiry, which is called naked option trade, it can be done in combination. The purpose of this combination, which is called as option strategy, is mainly to manage the risk by hedging. For example, if you have a bullish view, you can buy a call option at the strike price, 40,500 CE, and sell another call option at a higher strike price, 40,700 CE, of the same expiry. In this case, the max loss would be difference in premium of these two options. This strategy is called bull-call spread. There are many such well-defined option strategies for various market conditions. The example we saw and the scenario we discussed so far are taking a view of market as being bullish or bearish. What if we have a neutral view? Meaning, if we analyze and conclude that market will stay where it is currently within a range, we cannot deploy strategies which benefit only from underlying price movement. In such case, we can sell call option and put option which are at the strike price of range what we identify. This will result in profit because of premium decay by time. This is called theta decay. This strategy is called short strangle. In summary, index options trading can be done in many ways depending on market condition. This can be option buy, sell or hedged directional strategies or non-directional strategies. It is important to learn about options and strategies before trading in the market with real capital. This is because, unlike stock trading, the options trading come with more risk.